Now think about your financial goals. Are they clear in your mind, and do you have a plan to achieve them? Financial goals are the stepping stones to financial freedom. They provide a clear path to where you want to be and how to get there. These goals can be short-term, like saving for a vacation or paying off a credit card, or long-term, such as retirement savings or buying a home. But how does one achieve these goals? The answer is investing. By investing, you're putting your money to work for you, allowing it to grow over time. Whether it's through stocks, bonds, or real estate, investing plays a significant role in turning your financial aspirations into reality. So take a moment to outline your goals, determine if they're short-term or long-term, and think about how investing can help you achieve them. Remember, a goal without a plan is just a wish. Let's talk about risk. Are you a risk taker, or do you prefer to play it safe? Risk tolerance is all about how much uncertainty you can handle when it comes to your investments. It's a crucial factor to consider because it shapes how you approach your investment strategies. Think about it this way. If you're someone who prefers to play it safe, you might lean towards conservative investments like bonds or blue-chip stocks. On the other hand, if you're more of a risk taker, you might be comfortable investing in more volatile assets like small-cap stocks or cryptocurrencies. But how can you determine your risk tolerance? It's a blend of your financial ability to withstand losses and your emotional comfort with uncertainty. Consider your financial goals, your time horizon, and your financial situation. And remember, it's perfectly okay to seek professional help in assessing your risk tolerance. Knowing your risk tolerance is the first step in building a strategy that suits you. Before you start investing, you need to build a solid foundation, but what does that mean? Well, it's like building a house. You wouldn't start with the roof, would you? No, you'd start with a strong foundation. The same applies to your financial life. First, consider an emergency fund. It's a stash of money set aside to cover life's unexpected events. This could be anything from an unexpected medical bill to a sudden job loss. An emergency fund provides a safety net, so you don't have to dip into your investments when life throws a curveball. Next, pay off high-interest debts. If you're paying a lot of interest on credit card debt or personal loans, it's like trying to fill a bucket with a hole in the bottom. Paying off these debts before you start investing can actually give you a better return than most investments. A solid foundation gives you the financial stability you need to start investing. Now that you have a solid foundation, it's time to explore your investment options. First off, we have stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company's future earnings. They can be volatile, but they also offer high potential returns. Next, we have bonds. Bonds are loans you give to a company or government. In return, they promise to pay you back with interest. They're generally safer than stocks, but offer lower returns. Mutual funds and exchange-traded funds, or ETFs, are collections of stocks, bonds, or other assets. They offer instant diversification, but come with management fees. Lastly, there's real estate. Real estate investing involves buying properties to earn rental income or resell at a profit. It's tangible, but it also requires significant upfront capital and hands-on management. Each investment vehicle has its own risks and returns, so choose wisely. Ever heard the saying, "Don't put all your eggs in one basket"? That's exactly what diversification is all about. In the world of investing, diversification represents a strategy to spread your investments across various asset classes. It's a way to play it safe, to hedge your bets, if you will. Think of it like this. If you're holding a mix of stocks, bonds, real estate, commodities, and more, you're less likely to suffer a severe blow if one sector takes a nosedive. It's about not putting all your faith and resources into one thing, but instead spreading the risk around. Imagine you're a farmer with a variety of crops. If one type of crop fails due to bad weather, you'd still have others to fall back on. That's diversification in a nutshell. It's about balancing your portfolio to weather the storms and thrive in the sunshine. Diversification is your best defense against market volatility. Are you in it for the long haul, or are you looking for quick gains? This question frames the difference between long-term and short-term investing. In the short term, investments may be seen as a sprint. You're buying assets with the intention of capitalizing on quick market fluctuations. While the potential for high returns is there, so too is the risk. On the flip side, long-term investing is more of a marathon. It involves purchasing assets with the intention of holding them for years, or even decades. This strategy is based on the belief that over time, the market will grow consistently despite short-term fluctuations. The beauty of long-term investing is in its simplicity and patience. Take Warren Buffett for example. His buy-and-hold strategy has made him one of the most successful investors of all time. Remember, it's not about timing the market, but time in the market that can lead to substantial growth. Patience is a virtue, especially when it comes to investing. Before you invest, do your homework. Investing isn't a leap of faith, it's a calculated decision based on thorough research and due diligence. It's not just about picking a stock because a friend suggested it or you like the company's logo. You need to dig into the financial health of the company, understand its business model, and keep an eye on the industry trends. Reliable sources for financial news and market analysis can be your best allies. Websites like Bloomberg, The Wall Street Journal, or CNBC can provide a wealth of information. Likewise, tools such as Yahoo Finance and Google Finance offer comprehensive data on companies and their performance. Remember, every share of stock you buy is a piece of a company. You wouldn't buy a car without understanding its features, would you? So why would you buy a share in a company without understanding its business? Knowledge is power, especially in investing. The more you know, the better your decisions will be. Investing isn't free. It's important to understand the costs involved. When you invest, various fees can nibble away at your returns. These could be transaction fees, fund management fees, or even account maintenance fees. Imagine them as tiny termites gnawing at your financial tree. Over time, they can significantly reduce your nest egg. Now let's talk about brokerage platforms. Some offer commission-free trades, some charge per trade, while others might have annual or inactivity fees. It's like shopping for a car. You need to understand the total cost of ownership, not just the sticker price. To minimize investment costs, consider these tips. First, choose a low-cost brokerage that aligns with your investment needs. Second, consider index funds or ETFs. They typically have lower fees compared to actively managed funds. Lastly, avoid excessive trading. Each trade can carry a cost, and frequent trading can rack up fees quickly. Keep an eye on costs. After all, it's not what you earn but what you keep that counts. Investing isn't a set-and-forget endeavor. You need to stay informed. Being knowledgeable about market trends and keeping tabs on your investments is crucial to your financial success. Think of it as being on a long road trip. You wouldn't just set your GPS and then ignore it, would you? You'd check it periodically, adjust your route if needed, and be aware of the road conditions. The same applies to investing. Staying informed about market trends helps you understand the direction your investments are heading. It aids in making educated decisions, whether it's deciding to hold on to an investment or realizing it's time to let go. There are numerous resources available to help you track your investments and stay abreast of market trends. Financial news outlets, investment apps, and financial podcasts are just a few examples. Leverage these tools to keep an eye on your investments and the broader market. Remember, knowledge is power. Stay informed and stay ahead of the game. When it comes to investing, time is your best friend. The power of compounding, often dubbed as the eighth wonder of the world, is your secret weapon in wealth creation. And here's why. Imagine planting a seed today. Over time, it grows into a tree, bearing fruits year after year. This is exactly how compounding works. Your investments are those seeds, and the fruits are your returns, which, when reinvested, lead to more fruits or returns. The longer the time, the taller the tree, the more the fruits. Starting to invest early, even with small amounts, can lead to significant growth over time. This is thanks to the magic of compounding. But remember, consistency is key. Regular, consistent contributions to your investment accounts, no matter how small, are crucial. It's like watering your tree regularly, ensuring its steady growth. Start early, be consistent, and watch your wealth grow.